It's really great to be in Singapore now after the pandemic. This session is titled China and Global Capital Markets. And of course, this week we heard from Wang Qishan talking about opening up China. We also, of course, had the virtual summit which, in a way, eased some of the tensions there. But already we are continuing to see those regulatory pressures coming from both sides, sort of an incremental buildup. So in this panel, we want to discuss what that actually means for investments, capital markets, for innovation as well. Let me get started with Leland, who's joining me here, of course. Give us sort of the scene right now. Where are we at when it comes to this very much talked about financial decoupling that we thought was happening for the past couple of years?
Well, I think we can get it out of the way right up front, saying that true financial decoupling, in the most severest sense, is not happening and it will not happen. That said, one of the problems that we've run into right now is that there has not been an established framework, particularly from the American side, in terms of how to view the problems that are at stake here. We are seeing tech sector decoupling. We are seeing some supply chain decoupling. So the question is, what framework will be put into place that will be established enough that will take the focus off broader capital flows? To give you an example, one of the problems here, back in 2018, Congress mandated the Department of Commerce in the United States to come up with a list of emerging and foundational technologies, and they just didn't do it. So they didn't do it under the Trump administration. They haven't done it under the Biden administration yet. That was supposed to be sort of the linchpin under which a framework on export controls was set up. Now, maybe on top of that, you set up a mechanism so that people trying to get around it one way or another, whether it's CFIUS or another oversight body, would have the ability to sort of crack down and make sure bad things aren't happening. But when you have those types of frameworks, then you can stop talking about the bigger flows back and forth. But we don't have those in place yet.
Really, it seems the question is about uncertainty, right? I mean, things continue to change. We really have no clarity with all of these new rules and regulations. Nicolas, let me turn to you. And of course, you like to be referred as Gucho, so that's how I'm going to call you from here on. Tell us a little bit what you're seeing on the ground in Hong Kong, especially when it comes to liquidity flows as well as capital markets, because this regulatory landscape seems to continue to be changing.
Yeah, well, thank you, Shery. First of all, I'll just echo a little bit what Leland has just said, that from a pure Hong Kong point of view and looking at the potential decoupling, what we're seeing in terms of like the numbers and the level of activity, we're not really seeing a significant decoupling of any ways. On the contrary, we're seeing increased activity. If you look, for example, that 2 years ago, the amount of flows that we had at the Hong Kong Stock Exchange, the daily average traded volume was $89 billion. That was 2 years ago. This year, it'll probably be around 170, 180, and that's like almost doubled. And then we look at the foreign direct inflows into China, that's increased by 22%. You look at the holdings that international investors are having of onshore assets, that is also increased about 30% to about $1.2 trillion US. So whatever indicator you look, we're seeing more and more interaction. The channels are actually opening up. A couple of months ago, we announced the opening up of Bond Connect, southbound. So that's another indication that it's not only going one way, it's also going the other way from China to the world. So from China internationally and internationally into China, we're seeing more and more.
Right.
So we feel our role a little bit like being the connector of like East and West, the super connector, and what we're seeing is increasing levels of activity at this point. So no signs of decoupling at all.
Which is kind of what Gary and I were talking to on Bloomberg Television earlier. You were telling us that when it comes to venture capital, actually there's more interest right now.
Yeah, so I think the idea of decoupling is a fantasy held by people on the fringe because they don't understand supply chains, they don't understand technology. And so if you look at venture capital flows, this year will be $300 billion invested in companies, roughly 13,000 to 14,000 companies. This is by a multiple larger than any year in history. China will hit $100 billion of venture capital. So the innovation engine in China is being well funded. The challenge for the Chinese side is trying to reach out and control the capital markets too much. What Leland commented on is the U.S. has always been averse to industrial policy, and I think that remains the case. But there's three major initiatives. So Eric Schmidt, with a group of us, is heading up an AI initiative. There's a group working on semiconductors. There's a group working on advanced manufacturing. These are the first true industrial policy or technology policies that I've seen, and there's very broad support in the administration. But these are the kind of policies that prematurely announcing them creates more problems than it solves. And so I think that you will see things over time that will come out from those discussions, but they're not ready for prime time now.
Let's talk a little bit about some of the problems perhaps that China could be facing, of course. And there is a poll for all of you. So please open your apps and you can actually start voting for some of these answers that we want. Is China's economic rise assured is the question. And we do have 4 options. Yes, China can maintain 5 to 6% growth at least through 2030. There are no guarantees, but state capitalism will prove to be the superior economic model in the long run. No, China will fall into the middle income trap due to aging and lack of market reforms. We're headed for an economic crisis as China's housing bubble pops. So as I get your answers, let me turn back to Leland. Where do you stand in all of these options?
Okay, so I'm going to be pretty provocative here. I would say that D is wrong. I think A is wrong. I think B is wrong. I think C is the most likely, but with some tweaks. And certainly B, there would be people who argue that this has to play out. But I think what's happening here is something very dramatic in the Chinese economy. And what we're seeing right now is not just the normal ups and downs of the economy, just a gradually slowing economy. Right now is a paradigm shift on the level that we haven't seen maybe in 20 years in terms of what's happening on the ground in China. There is a move towards a much slower, hopefully healthier growth in China. So when you look at market predictions and what's happening, people like to grapple on the GDP and say things are dropping 10th of a percentage point or a little bit more. Now what we're seeing is something much more systemic, much more slower growth going forward.
Ooh, Gary, how do you respond to that? Because, of course, you're trying to find some opportunities in China, right?
Well, so the way to think about it, this is such a false premise in terms of slower growth in China. So up until 2009 or 10, the economic activity created every year in China would be less than they're creating this year. So 5% on a $14 trillion economy is a $700 billion increase in economic activity. That's what VCs play into. So we not only play into that today, we play into that over what is that going to look like 3, 5, 10 years later. And I think that the capital market, the incoming capital market in China has spoken in terms of the amount of companies being funded, the entrepreneurial energy in the country, and the amount of foreign investment that's oriented towards innovation still being applied. There'll be an issue on the back end in terms of liquidity that we can talk about later. But I don't think China needs to grow 5% a year to continue to be a great growth story. People are getting it wrong and they're focused on the percentage. It's the aggregate growth that's being created every year in the economy that matters.
Gucho, what do you think economic growth in China and also what that means for your company? Because, of course, we're talking about entrepreneurs. They grow and then they want to list somewhere. What's in the pipeline for you?
Well, I think when we look at a 10-year horizon, I feel pretty comfortable that we're going to see a continued trend of growth where the capital markets, I estimate that it'll actually triple over that period. So from roughly $30 trillion, $31 trillion, which is today, to well over $100 trillion. So the economy will probably more than double. China will become the largest economy in the world. I mean, and that's, with reasonable growth of 4 to 5%. So that we can say fairly comfortably. And we're going to continue seeing innovation. Some of the trends of tech companies becoming a bigger part of the scene will continue. So I call that, especially from a financial point of view, I call it the big bang of finance, because as a lot of that savings pool in China starts looking for opportunities internationally, we're going to see continued flow. The international investors will continue trying to seek those opportunities in China. So I would expect a lot more movement back and forth. And it's a trend that started many years ago, and we really don't see it slowing down significantly.
What's really interesting, right, because we continue to see the activity on the ground. By the way, we do have the result of that poll, and it's no, China will fall into the middle income trap due to aging and lack of market reforms. And of course, we have the regulatory crackdown to talk about, right? So, Gary, let me turn to you, because I do wonder, as somebody who invests in these early startups, in these companies, you're not facing that regulatory crackdown until much later, right? Until these companies actually become big enough. But how does that change your strategy in looking at these companies when the goalpost seems to be now completely different? Perhaps you don't want it to grow that much that it will actually get scrutinized.
Well, I think entrepreneurs never think about not growing. So the idea that Jack Ma today would say, well, I won't build Alibaba big enough to get attention of the regulators, that's not going to happen. So I think that what you have is you just have the practicality that what China has to come to grips with is the fact that the government is a trailing indicator. And so when you look at the regulatory framework now, it's stuff they should have done 10 years ago. They let fintech run away from them. They let the alternative finance, debt financing run away from them. They let Alibaba, Tencent, Baidu, and JD.com form effectively monopoly positions that choked a great deal of entrepreneurs trying to get into the market. So finally addressing that is a good thing. But ahead of them still is, can they create a stock market and a capital market system that the individual investor trusts? And they have not demonstrated in the 20-something years I've been doing venture in China, they've never demonstrated the ability to keep their hands off the market and trust that the market mechanisms work. I think that is the single biggest barrier to whether or not China has a robust system to actually achieve really reward the innovators and reward the entrepreneurs they have in place.
Which is why you're not very optimistic about the new Beijing Stock Exchange.
I find stock exchanges put in, centered in regulatory hotbeds to be less than ideal.
I bet, Leland, you have some comments on that too.
Well, I think just pulling this back a little bit, it sounds like the three of us are saying completely different things. But just to sort of clarify, when I'm talking about much slower growth going forward, I don't mean that China is uninvestable. I'm not meaning that people aren't going to make a lot of money, particularly in certain sectors. I think the dynamics of the economy will change as the government moves away from pushing credit expansion to boost those growth numbers up. So by saying slower, healthier growth, I'm not even saying that the party is doing a bad job. I'm saying that the party is embracing that too. So, there's a tendency, because we're so obsessed in the markets talking about the GDP growth number, because that's the way China has measured itself for so long, to think big number good, slow number bad, or slower number meaning that the government isn't doing its job. I would turn that around and say the faster that the party gets away from the previous economic growth model, which is focused enormously on reckless credit expansion. You saw that in the property sector. The more it gets away from that and the faster it does, the stronger and more resilient the economy will be in the long run.
So, Leland, is that what's driving Beijing right now with all of these regulations in different sectors of the economy? Because we're not only talking about tech, we're not only talking about this increased scrutiny in overseas listings, but also the property sector in so many different parts of the economy, education.
I think the social compact in China is changing right before our eyes. For years, the party said, support us. We will deliver you high growth, and we will make you rich. And we're getting to the point where the Chinese economic growth model can no longer deliver those high levels of growth. And instead, what the party is saying is, we will deliver slower, healthier growth, and we will distribute the wealth more broadly. So you're seeing that a little bit in common prosperity and the rhetoric around that. But you're going to also see it reflected in economic policymaking. And so why was the financial sector so aggressively de-risked this year? Why was the property sector? Why is it being so aggressively de-risked? Because I think the party looks at the risks of not changing as greater than the risks of pushing this forward, albeit with volatility, with economic dislocations and defaults and other problems that come along with it, because this is the way that it ensures its own survival going forward.
Gucha, what does that mean for you on the ground as somebody who's heading the Hong Kong exchange, if you're seeing Beijing wanting to change because they have to?
Yeah. So, I mean, what's happening is you have a new generation of businesses as a result of the new economy that are creating certain imbalances in the market, and there's additional regulation coming in to try to understand how that works. In the short term, I would expect regulatory pressures and regulatory changes to continue as the country adapts to overseeing a new type of industry that has not existed before. And I agree, it's mostly centered around how to manage income inequality, how to manage managing these large businesses that have so much influence into the market. And then, of course, you have the side that is related to privacy laws, related to data security, national security, et cetera. So that will probably continue. But if I look at the medium long term, I do believe that this will probably set the rules of the game, and a lot of countries around the world will probably follow similar policies in terms of trying to regulate sectors that are new and we're all learning about. So as a new economy market, because Hong Kong Exchange is fundamentally a new economy market, we do see that this will allow for healthier growth in the future,
right.
But there will be hiccups along the way.
What about the competition with mainland exchanges, though? Because, of course, Hong Kong has biotech funding, and as you say, the new economy companies, but at the same time, we have seen all of these new exchanges, whether it's Starboard or the Beijing Stock Exchange. Of course, we have Chinext as well.
Right. So we're deeply connected, actually, with the exchanges on the mainland. So we have our Stock Connect program that is today a very, very significant part of Hong Kong Exchange. So there's connection, there's single liquidity pool.
So you don't see that as a competitive, as a competition, as a rivalry dynamic there?
We actually think that as the market grows, the fact that the exchanges are working together and connected will allow the whole pie to get bigger. If you just recall the point that I made that with the market going from 30 trillion to 100 trillion, that's enough space for like all markets. And in the case of Hong Kong, we have a market where people know the regulation, free flow of information, they know how to deal with it, there's all the expertise, you have all the professional industry, the infrastructure, it's all here. So you deal in a market that you know how to deal, but you get the ability to have access either to the Starboard market, to the Shanghai market, to the Shenzhen market. So it creates this ecosystem, which is amazing, that allows for really, investing in China, investing in Asia through one roof that everyone knows very, very well and feels very comfortable with.
Leland, what do you think?
That's really not my expertise. I'll kick this one over to Gary.
So sorry, let me make a comment on this, because the thing that the Chinese government will make a mistake on, because they're very consistent in this mistake, is they're going to overreach, and they'll do regulation not to create a fair market, but to control the market. And history would say you cannot control technology markets. Try to find an example over history where someone was able to put a fence around and control the development and enhancement, distribution of technology. Very hard to find. Kind of like water, hard to control water. It's very expensive to control water. The financial markets are the same thing. I mean, I think that if Hong Kong can remain independent and doesn't have the same kind of listing requirements that the main boards have in terms of the security administration saying, well, you can list here, you can't list. If Hong Kong can maintain that independence, then I'd completely agree. Hong Kong will thrive. But the data would say today that that's not guaranteed in any way.
How difficult has it been to drum up interest for Chinese companies when you have that regulatory backdrop?
So again, it hasn't affected the front end yet. So the front end, lots of capital coming in, lots of companies being funded. What changes for an American investor or a foreign investor is Hong Kong has a great system where innovative company can list. 6 months after listing, you can start to distribute shares. You can become liquid in the investment. The main bourses in China have a 1-year lockup. So first of all, the listing requirements are harder. Then you have a 1-year lockup. Then if you own a large position, you can only sell 3% of the company per quarter. So instead of a 6-month to liquidity process, it's 18, 24 months or longer. That is a risk. Every investor has to calculate 2 more years of geopolitical risk in terms of the exit of that capital. That's a big deal.
You've been a little bit more careful when it comes to these sectors that you're trying to put money in.
Well, so there's no point. Every sector at some point becomes too expensive. That's just the law of large numbers. So we're the largest healthcare investor in China. We'll continue to be very aggressive on healthcare broadly based. And what we've done is move mostly from consumer investments to a very broad base of technology, core technology investments. And so it's much more the things that will underpin a complete rehosting of the Chinese technology sector onto purely domestic technology as opposed to foreign technology.
Leland, How are U.S. investors, U.S. businesses watching these developments in China, and how do they think the opportunities will change given what we're seeing happen?
Well, I think you're seeing a bifurcation based on funds' risk appetite. So I'm always asked the question, is China investable? And I think the answer is yes, but it also depends who you are. So if you're a pension fund before and you probably thought there were some very sure bets with very little volatility, all of a sudden you see these policy crackdowns, which have no guarantee to be ending anytime soon, because we're looking at the Party Congress next fall. This could go on for quite a while. You may not have the appetite to invest in China anymore. On the other end, there's lots of hedge funds. There's other vehicles with high risk appetite that see these values that look so appetizing, and they just have to play the political winds right, and they're going to make a lot of money. So I think that you're seeing, instead of this broad question about is China investable, well, China's investable, but it really, really depends on who you are and what you're trying to get out of it.
And Gucho, given the conversations that we're having these days, we have seen more people look to Singapore, where we're at right now, as perhaps another opportunity, the SGX. We heard from a CEO saying, you know what, we want to anchor the funds and have them list here instead of Hong Kong. And not that he said that, but we kind of gauged that that's a competition there. How do you make yourself still competitive in that environment?
Yeah. So I do believe that Southeast Asia presents an incredible opportunity for the long term, and the linkages with China. These are very large domestic markets all around that eventually will have more interaction, more connection. The fact that we are the most international city in China and the most Chinese city outside of the mainland is a very unique positioning. And that allows us to be in an incredibly good opportunity to create an ecosystem. And one example is, like, for example, we just recently launched an A50 futures contract, and it was incredibly successful. In just like 3 weeks, we have this week pretty much every day over $1 billion of trading, and there's an open interest built of over $2 billion. So having that in just like 3 weeks gives you a sense of like the power of trying to connect this East and West. But I do believe that being able to also get Southeast Asia connected with all this ecosystem is going to be highly valuable. And I think that's going to be positive for Singapore exchange, for the Hong Kong exchange, and hopefully the pie will continue to grow and we'll all be able to facilitate, getting those opportunities together with capital.
Right. Let's take some questions from the floor. If you have any questions, you can raise your hand, and we will try to address them. But that's a very positive note that you're ending on, Gucho, in the sense that we're trying to grow the pie. Gary, as somebody who invests in China, what would you like to see in order to make the environment better for VC, better for innovation, better for entrepreneurs? So
I think it's having the rules be clear and having some predictability to the rules. I think what we have now is a late entry, the CAC, the Cyberspace Authority, coming in and taking control of the tech company listing process. Well, that leaves CSRC out of the mix, and they're the ones who actually have created the technology underpinnings of the stock market. So at some point, you need to have people in place who have a deep knowledge of how the markets function. And if that doesn't happen, then you'll wind up with companies, at some point, capital will stop flowing to China as aggressively as it has. No one's going to completely pull out of China because the market dynamics, to the point that Leland is making, they're fantastic. Long term, it's a very great place to invest. But everyone's risk premium will have to get adjusted for the time frame of liquidity. And that's something I think the Chinese are going to have to address. Leland, just quickly, final thoughts?
I think that the issue should be do smart things on the regulatory side. And when I look to the U.S., part of the problem with what the Trump administration did is they were starting from a very unregulated space, and they try to do a lot of things. I think it's incumbent on us to move forward, hold China to the rules, whether it's auditing or other things, but at the same time be very, very specific in what you're trying to ring fence and what you're not, trying to give investors that transparency, and then I think that everything can move forward in a much more fluid fashion. Leland, Gucho, Gary, thank you so much for being here with us.
Pleasure.